Behind the trillions of dollars in life insurance currently in force lies a specific structural design extending beyond a simple death benefit. Every contract originates as a risk pool built on a three-entity triangle: the insurer, the policyholder, and the beneficiary. This model operates through a consistent exchange. The policyholder provides premium payments, and the insurer assumes the mortality risk on behalf of the beneficiary. In the context of corporate finance and private wealth, however, this basic triangle is intentionally decoupled and re-engineered. Strategic shifts in ownership and liquidity retool this risk pool into a highly versatile financial asset. Understanding the modern life insurance contract requires mapping three distinct points of control: ownership, liquidity, and taxation. The first modification is third-party ownership. It severs the traditional link, allowing a corporate entity to assume total control. The insured individual holds no legal rights to cash value or beneficiaries. All authority routes exclusively through the business. This structure provides the foundation for key person insurance. When a business depends on the unique expertise of a specific employee, their loss creates an immediate financial vulnerability. This policy indemnifies the business, providing capital to replace revenue and fund the search for a successor. A secondary application of this ownership structure is the buy-sell agreement. Upon the death of a business partner, the agreement triggers an immediate injection of liquidity. This capital purchases the deceased partner's equity, which is then redistributed to the surviving partners. This mechanism prevents external heirs from forcing a liquidation and protects the company from the balance sheet instability that often follows the loss of a founder. Within a corporate framework, life insurance functions as a stabilizing scaffold for long-term business continuity. Policyholders often reach a point where premium obligations become unsustainable, or the original risk profile of the family has changed. Rather than surrendering the policy back to the insurer, the owner can engage in a life settlement, the legal sale of an active policy to an institutional investor. This transaction relies on a specific delta. The investor pays a lump sum higher than the surrender value, but lower than the eventual death benefit. Following the sale, the investor assumes all future premium payments, maintaining the asset until the final payout. Because these sales involve the valuation of human life, state-level regulations strictly govern the process to protect the seller's interests. The secondary market allows an illiquid obligation to function as a tradable asset. While individual contracts are precisely tuned, group life insurance operates on a collective scale, covering an entire employer risk pool. These plans follow two funding models: non-contributory, where the employer pays the entire premium, and contributory, where the cost is shared with the employees. The primary risk of a group plan is its conditional nature. If an employee leaves the company, their coverage terminates immediately. To bridge this gap, the insurance contract includes a conversion privilege. This legal mechanism allows a departing employee to convert their group coverage into a permanent individual policy without providing evidence of medical insurability. This privilege is subject to strict constraints, typically limiting the types of permanent policies available and capping the total coverage amount. Despite these limits, the conversion privilege ensures that employer-sponsored benefits can be salvaged into individual financial assets. The engineering of any life insurance policy is ultimately dictated by federal tax law. The IRS provides significant tax advantages to these contracts, including tax-deferred growth of cash values and an income tax-free death benefit for beneficiaries. However, these advantages are capped. To prevent tax sheltering, the IRS enforces a 7-pay test to limit cash deposits over the first 7 years. Breaching this limit permanently reclassifies the policy as a modified endowment contract, or MEC. Once a policy becomes a MEC, standard withdrawals and loans lose their tax-deferred status. They are treated as taxable income. Furthermore, any funds accessed before age 59.5 incur an additional 10% early withdrawal penalty. This status is irreversible. Once the funding threshold is crossed, the IRS prevents the contract from ever returning to its original tax advantage state. The MEC threshold is a definitive boundary designed to penalize the use of insurance as a high-yield, short-term investment vehicle. The landscape of life insurance is defined by 3 factors: corporate ownership, secondary market liquidity, and federal tax boundaries. The economic utility of these contracts depends on the specific configuration of their legal and financial variables. Ownership determines control. The secondary market provides liquidity, and premium volume dictates the tax status of the asset. Effective management of this complex asset requires the flawless, ongoing alignment of corporate risk mitigation and tax compliance. Aligning these variables allows a standard death benefit to function as a precisely engineered financial instrument.